A quick reminder that BTC Markets does not offer tax advice. Anything discussed in this video is for general informational purposes only. For professional advice, please consult an accountant. Hello and welcome to the BTC Markets tax series, where we try to tackle the complexities around crypto tax reporting in Australia. I'm Charlie Sherry, the head of finance at BTC Markets, and I'll be your host. Today, I'm joined by Nick Christie, co-founder at Syla. Nick, thanks for joining us.
Yeah, thanks so much for inviting us on, and yeah, it's a pleasure to be here. As said, I'm one of the co-founders at Syla. Basically, we're a crypto tax software specifically designed for Australian tax law, so that investors can, plug all their numbers into our software, work out those tax outcomes. We have some tax optimization we do as well, so that you can get your tax sorted each year.
Awesome, appreciate the intro. So, yeah, could you just explain how you got involved in crypto tax in the first place, and a bit about Syla?
Yeah, sure. I guess, my sort of start in crypto was not in tax. It was as an investor myself. So about 6 or so years ago, I first started to get into it. So it was really interesting. And I started to really actively trade myself. So I was actually trading quite frequently, had some automated software that I was actually using that I had developed, and I was running that on a few Australian exchanges, which was really exciting. But it wasn't until about a year later when I started to look at, how am I going to do the tax for all of this, when I realized there's a pretty big problem there. How do we plug all these numbers together, work out the tax outcomes, and declare that properly as well? So that's how I made that transition into the tax side, just from my own sort of pain that I was experiencing. And it wouldn't be the only one. And that's why we went down that path to let's build some software that, one, I can use for myself, but also other Australians will be able to use as well.
Yeah, okay. That's pretty interesting. I'm personally invested in crypto as well. And the tax side can be almost a bigger headache than worrying about your finances. So I definitely appreciate the work you guys have done to bring Syla to the market. So I guess to dig into the whole tax side of things a little deeper now that we are at tax time here in Australia, can you give us some examples of what triggers a tax event for investors, and when they really need to start being conscious of how their activities might trigger tax events?
Yeah, well, we're just going into tax season, so it's obviously on everyone's minds at the moment is, I've made all these investments, I've done this trading, and I've used all these different platforms and wallets, and how do I put it all together, and what's taxable, what's not? So it's definitely that time of year. I think, first of all, if you've only purchased crypto and you've held it on an exchange and you just held it, you actually don't have any taxable events. So that's something really cool. And you can keep holding that crypto for as long as you want, and you never have to worry about, what tax you'll have to pay until you actually sell it right. But you have to be quite careful because there's a lot of different tax events that aren't quite intuitive all the time. So obviously, if you sell your cryptocurrency, that's going to be a taxable event, right? But you also have things like swaps, like crypto to crypto swaps. You have airdrops, you have staking, you have other forms of interest that you could be earning. And all of these things are taxable events, and you do have to work out what are the tax outcomes going to be on those, how do I calculate it, and then how do I actually go about declaring it as well.
Yeah, and does Syla help its customers sort of manage all those complexities, helps identify when there is a taxable event and then the tax impacts of that?
Yeah, I think that's the easiest way to work it out, right? Because we're not all tax experts. So I think the easiest thing to at least get an initial idea, right, to see what's going on is plug it into your Syla account, for example. So you can import all your transactions into there. Syla can detect what those are and classifies them for you. And it's going to apply the tax outcomes as well. So you can actually get a really good idea of what your tax outcomes are without being a tax expert, right? And if you have some really complicated sort of situation you're in, of course, you can always talk to your tax agent or tax professional, and they can give you advice on those transactions as well.
Yeah, okay. And can Syla be helpful in, working with its customers to help them pay less tax in a given year, depending on their activities, of course?
Yeah, of course. So the role of Syla is two things. One, you need to record your transactions. And then two, also, how can we optimize to help you save tax? So There's actually like two main ways I think that investors in particular can minimize their tax in Australia. The first one you've probably heard of, it's called the 50% CGT discount. So if you're an individual, you held your crypto as an investment asset and you held it for over 12 months, you can basically cut your gains in half, which is fantastic. It's really simple. There's no fancy structures that you need to set up. You just buy and hold the crypto and you're going to save tax in the long run, right? And then there's a second way, and it's something special that Syla also does, which is called the parcel selection method that you're allowed to choose. So you might have heard of something called FIFO, or first in, first out. This is basically a method which helps you decide which crypto you sold when you purchased multiple lots of it throughout the year, all at different prices. So you can imagine if you bought Bitcoin, let's say you purchased it for $50,000, like one Bitcoin. And then a little bit later, you purchased another one Bitcoin, but the price was a little bit different. This time it was 60,000. And then you decide to finally sell one of them, right? And you have to ask that question, which one did I sell? Did I sell the first one that I bought, or was it the second one that I bought? And that's where those parcel methods come into play. So if you choose first in, first out, it's the first one. Then we have other methods like last in, first out, where you would pick like the last one, right? But in Australia, you actually get to choose. So you're allowed to, basically a free choice. You can pick and choose. You can pick the first one. You can pick the last one. You can pick one of the ones in between if there were mill purchases. And that's where our team at Syla have developed a special algorithm that we call lowest tax first out. And basically what that does is it looks through all of your purchases that you've made through the year, and it simulates, if I choose that one, what's the tax outcome going to be? And it takes into account the CGT discount as well. And basically it picks the one that's going to give you the best tax outcome, right? Because that's what we all want.
Okay, so there's a bit to unpack there. So as you mentioned, you can select your preferred tax treatment method, be it first in, first out, last in, first out, or otherwise in a given tax year. And can you change that method year over year? And as well as that, can you change or like choose which treatment to use on any given transaction in a tax year?
Yeah, you can, but there is a caveat, and that is that the software that you use also has to support that. So this is a common thing that catches some people out is, they might have started, they're using their software and they chose first in, first out. Now, you're allowed to change it in Australia by our tax law, but obviously the software that you're using, the way that you're recording your transactions, it also has to support it. So in Syla, you're sort of in luck because you can keep your first in, first out if that's what you declared last year, for example, and then adopt a new method for the current year without affecting your prior tax outcomes. So provided you are doing the record keeping correctly and your software supports it, you can change that method each year.
Okay, interesting. That's so the algorithm you mentioned from Syla. Did you have a name for it? I can't remember.
Called LTFO, or lowest tax first out.
First out. So that'll calculate the most optimal tax method for you to use on a given transaction, based on doing a calculation on all methods, right?
Yeah, that's right. Just imagine, especially for those people who have been steadily buying through the year, imagine your dollar cost averaging into the investment. So every week or however often that you're purchasing, you purchase another parcel. And obviously the price is varying all through the year, right? Because the crypto is going up, it's going down. So you've purchased all these lots at a different price. And then you start to sell some of them because obviously at some point you want to start to sell down something. Maybe you've got a big purchase that you want to make, but you don't sell everything. You're just selling part of the portfolio. That's where this method, like lowest tax first out, is going to do a really good job for you. It's going to look through your entire past history of purchases. And each time you sell, it's going to pick the one that's going to give you the lower tax outcome for that disposal. So this is a great way to minimize your tax.
Yeah, for sure. And what are some of the common issues or pitfalls that investors run into when it comes to tax on their crypto?
Yeah, I think a lot of people, there's a lot of content out there now about tax. So we all have some intuitive sense of how crypto should be taxed, at least to some extent. But then you actually have to get the work done as well. So one common pitfall that we see quite often is that people are only importing their transactions for the current financial year. So they're doing their 2024 tax return. So makes sense. I'm going to export all my transaction statements for 2024, plug it into the software and work out what my tax outcomes are. But that's not such a good idea because CGT calculations, they require knowledge of what were the original purchase costs for your assets. And those purchases can have happened in a prior year. So if you haven't imported all your transactions going all the way back and basically you have to import everything, you're not going to get the right tax outcomes on that.
Right.
So it can be tricky. That's why it's complicated, honestly, but that's why the software is there to help you. But that's the first tip, is just make sure that you're importing all your transactions right, not just the current year.
Yeah.
And not just for your exchanges, which sort of brings me to the second common pitfall that we see is people forget to import their wallets as well. So it's really good to import the transactions on your exchange. That makes sense, but also on your wallets as well. So even if you're only using them for cold storage, like you're just sitting there and holding them, it's still a really good idea to import those data sources as well. The reason for that is, one, there might be taxable events, especially if you're doing like on-chain swaps or staking or something like that. So then, of course, it's important to import. But two, it's just helpful to track your portfolio and understand what's happened to make sure everything has been imported. And then the software that you'll be using most of the time when you import that additional wallet, it's going to help you identify the transfers from your exchange to the wallet, so it can treat those as non-taxable transfers. So it's a really good idea to import basically everywhere you have crypto. You should import that into your software so you can work out the tax outcomes correctly.
Okay, thanks for that. And another thing that I've come across in some tax softwares is tax loss harvesting, and identifies some of those opportunities for you based on your activities in the year. Can you describe what that is and how users can use it to reduce their tax liabilities?
Yeah, tax loss harvesting is an interesting one because I think like sometimes it can mean two things. It depends like where you're reading that information from as well, because it is a bit of an Americanized term, but that's the way that we sort of see it. So it can mean two things, and you should try and understand the difference, because one's like really, it's totally fine to do, and the other one is sort of not okay to do. It's actually illegal. So maybe we should discuss like what the difference is between those two. The first one, yeah, okay. So what's the one which is okay? The first one is like basically it's a form of tax planning. So you get to be close to the end of the financial year, so just before 30th of June, and you look at all your investment portfolio and you see some of your investments haven't done so well, right? They're sitting on an unrealized loss. So what can happen is you review your portfolio, look at those investments that have a loss and say, okay, I'm going to sell some of these because I don't think they're a good investment anymore. And why do you want to do that? Because if you sell that asset that's sitting at an unrealized loss, you're going to realize it. It's going to be now a realized capital loss. And what you do with that is you offset your other capital gains. So if you have a lot of capital gains, you want to lower them so you pay less tax, right? At the end of the day, that's what you can do. Review your portfolio, see which ones aren't so good anymore out of those investments and sell them. Now, that sounds really good. And then usually what some people say is like, okay, I want to realize those capital losses, but I don't really want to sell the investment. So what I'm going to do is I'm going to sell it. I'll wait a few days and now I'm going to buy it back. Now, in Australia, that's called a wash sale. So that's actually a form of tax avoidance. Basically, you're not allowed to do it. So what you need to be careful is just make sure when you're doing that tax loss harvesting is make sure it's an investment you actually want to sell and not one that you're going to immediately buy back.
Yeah, so it's like a genuine sale or genuine disposal in that example.
Yeah, that's right.
Yeah. And I suppose you alluded to wash selling there. Like, what are the consequences of not necessarily that, but like inaccurate crypto tax reporting in Australia?
Yeah, I guess like everyone has that legal responsibility to declare their tax. So that's where it comes from. And that includes your income derived from crypto investments, whether that's gains or staking, whatever income that you have. And you just need to be careful because if you fail to declare your tax, obviously there can be penalties that you can receive from the ATO. In really extreme situations where you've purposefully sort of avoided tax, then that may even lead to like criminal prosecution for tax avoidance. So basically, you should make sure you're always reporting your tax from your crypto. It's not really worth, trying to avoid it. And with the software now, I sort of get it because in the past it was really, really challenging to do your tax correctly for crypto investments. Just because of the nature of it. But with software like Syla, it really does become a lot easier. So it's not like so easy to just stick your head in the sand anymore, right? Like it is possible to do. Let's make sure we're doing it right. But also at the same time, you shouldn't overpay on your tax either. So if you can minimize it, why not?
Yeah. So how can people ensure they are compliant in a given tax year? Probably more so than they would have been able to pre-software, as you mentioned.
Yeah, I think there's like a few key components to make sure everything's good. One, make sure you're keeping good records of your investments. For me personally, I recommend using Australian-based exchanges in particular. I think from what we've seen at Syla, the Aussie exchanges have a much higher standard of transaction reporting, which is fantastic because that actually makes it a lot easier to stay compliant when you have to use the software, when you have to work out your tax at the end of the year. So that's a really good tip. The second thing is don't try to do it by hand. I think if you have like maybe 10 transactions, okay, fine, give it a shot, or take those, that statement to your accountant and they can maybe work it out. That's okay. But most of the time, what we see is people have hundreds of transactions at minimum, if not thousands or tens of thousands. And at that point, you really do need something that is a bit more dedicated. So that's why I use tax software like Syla to do that. It's just going to save you a lot of time. It's going to make sure the tax calculations are done accurately as well. The last trick is, I think, if you have a more complex situation, don't be afraid to reach out to like a tax professional or even a crypto tax professional to give you a hand. They'll obviously be able to give you sort of more advice. They'll be able to use the software as well if you're not comfortable using it, and just make sure everything's been done correctly.
Yeah, okay. And crypto tax is ever evolving. I suppose it's still a pretty new space, and tax departments are trying to keep up with it like the rest of us. Have you seen any trends or developments in the last couple of years with crypto tax in Australia that have been noteworthy to you?
Oh, yeah. This financial year, we're seeing sort of like two trends. I don't know, the ones which sort of stand out to me. One, we've seen some of those people who've been in the market for a little bit longer, like, 4 or 5 years, and buy and hold, and their investments have gone up. We're seeing them sort of cashing out a little bit of their portfolio, which is good. They're starting to realize some of those gains, and then they're using that for maybe like a large purchase, like a home deposit, right, to purchase their first property or something like that, which I think is fantastic because that's what it's all about. And then the other trend we're seeing this year is meme coins. They're everywhere at the moment. So people are dabbling in a whole range of different sort of fun meme coins. They can be a bit hit or miss. If you make a lot, that's fantastic. If you make a loss, but don't forget you can also claim those losses because they're going to be able to offset your bill as well. So.
Okay, interesting. So, yeah, I guess as a final piece, like, what would you say are the keys to crypto tax happiness for tax reporters?
Yeah, I think this is like our goal at Syla, right? Like, let's eliminate the pain of tax and have some crypto tax happiness for once, where everything just goes smoothly. And I think the key to that is like 3 things. One is make sure you have the great record keeping. So make sure you're keeping those detailed records through the year. Use a good Australian exchange, is really helpful for that as well. Just going to make it easier to get all your records each year. The second part is don't leave everything to the last minute. Even before the financial year has ended, like, you can start to compile your records, like sign up for a free account in Syla. You can import all your transactions. That does a second thing. It actually means you can plan your tax through the year. And that's the third part is, don't be trying to catch up to your tax, like actually plan for it in advance, because that's where you can one, make better investment decisions, but two, also have an easier tax year. So just keep everything up to date, import it into Syla, see what your tax position is through the year, check what you have before the financial year is ended as well to see if you can like harvest any of those losses or minimize in any way. And yeah, just be proactive about it.
Yeah. Okay, great. Thank you. Okay, Nick, so you mentioned earlier around the consequences of a lack of compliance with someone's tax reporting. I'm also somewhat familiar with the ATO data matching program. So I guess in terms of the question, like how does the ATO know if I've been involved with crypto, given, it is seen as like an anonymous sort of industry? Can you talk a little bit about that and how that works? Is probably something that our viewers should be aware of.
Yeah, it's always like two questions that I get asked is one, the first one is always, do I have to pay tax on my crypto? And then obviously the answer is yes, cryptocurrency is taxable. I think that's pretty well established now. And then the second question is, well, okay, but how is the ATO even going to know about my crypto, right? Because it's meant to be anonymous. You're not meant to be able to track it or anything like that. But the reality is a little bit different. So the ATO actually has a well-established data matching program specifically for crypto investments. Basically the way that works is every AUSTRAC registered exchange or service in Australia that deals with cryptocurrency, the ATO actually operates a data matching program with them. So they can request the transaction data of those individuals who use the platform. And that's how the ATO is able to know, one, that you have crypto and what those transactions are. So you can actually see this in practice when you go to do your tax return. If you're doing it yourself and you're self-lodging, when you log in to MyTax and start to fill it out, it's actually going to pop up and say, hey, we know you have crypto, make sure you declare it. Or two, you may actually receive a letter from the ATO. If you haven't declared any capital gains, they will know that, hey, we think you should have some, right? Because we know you made sales on this exchange. So how come you didn't declare any capital gains? They will send a letter out to you and say, make sure, why haven't you declared? And that's how the ATO knows, basically. So, yeah, it's not really a safe assumption to make. And the other important thing is, even if the ATO isn't collecting data, say, on-chain today, that data is permanently there. That's like one of the big features of blockchain is that it's perfectly immutable, right? It's not going away. So yeah, even though maybe they're not understanding data right now, they can come back anytime, have a look at it and say, hey, we saw all your swaps on chain as well. And maybe you should have declared that back then.
Yeah. Correct. Like wallet addresses are in a vacuum anonymous, but those addresses can be tied to you through your reporting. And if you use that forever, then it does become a bit of a ledger for yourself. So it is always worth staying compliant. Another thing we could touch on is, I suppose, what types of transactions are taxable that, you mightn't always think are. For example, if you pay, crypto is becoming a little bit more accepted as a means of payment in the real world these days. It is at a taxable event. If you pay for something online with your Bitcoin or Ethereum, could you actually have a tax liability to pay on top of that?
I think there's like one sure thing. If you have to ask the question, do I have to pay tax? The answer is almost always yes. There'll be some way that the ATO wants to tax you, right? So the question is just like, how does that work? For the example of payments, that's a good example because there's this thing called the personal use asset exemption. I think some people have maybe heard of that. I think hopefully it applies to them. So that's where if you purchase crypto under $10,000, you use it for personal use, then potentially it could be exempt from tax. But the application of that is super specific. So if you look at the examples from the ATO, it's like, okay, I purchased this Bitcoin, and then the next day I used it to purchase some tickets online for a concert. So you bought it, immediately used it for a personal use purchase, then maybe it could be exempt. But realistically, like I never see people doing that in practice. Most of the time, they're buying, it's an investment, and then maybe like a year later or sometime later, they're starting to use it for some card purchases or things like that. So that often doesn't apply. The second one is, okay, what if I like set up a credit card or my platform I use has a card that they offer where I can use crypto directly for purchases? That's fine. Like you can do that. There's no issue. But every time you make a purchase using cryptocurrency, that's a disposal event because you had the investment and now you don't. It's gone. That's a CGT disposal. You have to work out the gain or loss is on that disposal. So if you are using it for a lot of personal use purchases, so you're using it like by card or you're using it directly purchasing online, you actually still need to keep track of all of those and work out what all those capital gains and losses are on each purchase that you've made.
Yeah, interesting. Another trend, we talked about some trends in the market this year. Another trend that's been big in this tax year has been airdrops. Could you give a bit of an explanation of what those are and how they are taxed in Australia?
Yeah, airdrops are an interesting one because the ATO has provided a little bit of extra guidance around those and how they could be treated. An airdrop is sort of where, let's say you're a holder of some asset on a chain and then there's a new project they've launched and they just give away all these tokens to you, right? So it's just like freebies, which is fantastic. Unfortunately, everything has tax outcomes, as we know. So we have to look at those airdrops and say, hey, what's the tax outcomes going to be on this? The ATO has like grouped these into two types of airdrops. One is an airdrop from an established token. So this might be where you're receiving regular airdrops from a particular project. Those are going to be classed as ordinary income. So you have to work out what's the market value at the time I received it, and you have to declare that as income on your tax return. And then the second type is called an initial allocation airdrop. An initial allocation airdrop is like where you receive that token at the very beginning of the project where it has no established market value. In that case, potentially, there may be no income that you need to declare on that because it's not really worth anything at that time.
Okay. Complex for sure.
Complex, yeah. They like to make it hard, I know.
Yeah. But it is encouraging to see that the ATO is coming up with guidance for these complexities and trying to keep up with the ever-evolving world of crypto, given it is still so new. So some other crypto market trends that people might be involved in, such as like NFTs, are they taxable and how does tax work on those?
Yeah, NFTs work a little bit differently to sort of normal tokens or cryptocurrency. The key difference for an NFT is that it's in the name, it's non-fungible. So if you're purchasing Bitcoin and you purchase multiple units of Bitcoin, they're all basically the same. They're fungible. So you can interchange one for the other. They're all priced exactly the same. The key difference for an NFT, of course, is that each NFT is perfectly unique. So that means you can't like mix and match them. So if you buy one NFT and you sell it, that's the exact one that you sold. So you can't do those parcel matching methods like first in, first out, and those don't really apply because you know exactly which one you sold. And the other important thing is that it's really hard to get market valuations for NFTs because how do you know what the value of one specific NFT is until it actually trades somewhere? Someone actually exchanges it for something else. So that's the key challenge for NFTs as well, is how do we get accurate pricing data for that?
Yeah. Okay. Interesting. And what would you say are like the biggest issues that people have, like based on the customers that use Syla? Like, we've talked about NFTs and airdrops and staking and swapping. What parts of the crypto ecosystem do you think cause the most complexity for tax reporting?
Yeah, the most complex areas for tax reporting is if you're on the bleeding edge in the crypto space, that's where you're going to have the most challenge. So if you're using like a brand new chain that's only recently been adopted into the market, there's not going to be a lot of support in any of the software of how to how do we get the data from that chain? How do we classify and understand it? Because it's so new. So if you're on a really, really new bleeding edge, cutting edge area of crypto space, that's going to make your tax reporting more challenging, and it's something that you should take into account when you do it.
Yeah, it is an ever evolving space. It's hard for the technology to keep up. The technology that is feeding into on top of crypto, I guess.
There's so many chains now. Yeah.
So you guys are not short of work at Syla.
Definitely not. No.
Okay, and one other thing we should mention, Nick, is the partnership that BTC Markets has with Syla, and that BTC Markets customers can avail of the Syla software. And I think you have a discount code for us. Is that correct?
Yes. So BTC Markets customers, we have a full support and integration in Syla for BTC Markets. So it's really simple to connect directly, sync your transactions in, or you can use like a file import to get all your data into Syla. And we also have some special offers and discount codes for this tax season. So if you're sort of just getting started into crypto and you want to keep your costs down, you can sign up to Syla's budget plan for $5. So basically that means you have a full annual subscription. You can import all your data, work out your tax outcomes, and generate a report. It's only $5 for your first year, which is a fantastic way to get started. And the second offer is if you want to use one of the more premium plans, you can sign up, get a 50% discount. So using discount code BTCM50, you can get 50% off your first year subscription.
Awesome. That's great. Okay, well, thanks for joining us today, Nick. Really appreciate the time. I hope that was informative to our listeners and useful in tackling your crypto tax reporting for 2024. Thank you.
Yeah, thanks so much.